Hello, dear traders. Last week, the economic calendar was quite eventful. Macro stats significantly impacted market sentiment. It appears fundamental factors will continue to shape market trends until the Fed's meeting. Nevertheless, market uncertainty persists this summer. Fresh inflation figures exceeded analysts' forecasts, so some Fed policymakers stressed the need to hike the key rate more aggressively in July. However, it's still unclear whether the Fed may raise the cash rate by 100 basis points at its next meeting. Despite quite a busy week, Wall Street did not show clear-cut trends. Three benchmark stock indices traded mixed. Their price changes were quite insignificant. The new week kicked off on a positive note. The US economic calendar is empty. There will be only reports of less importance to traders. For this reason, investors are focusing their attention on the earning ones. Market sentiment will mainly depend on the quarterly results of US companies. Watch our video review to find out more details and feel free to leave your comments down below. Let's start. Last week, speculators were looking forward to Wednesday, as the US was going to reveal its inflation figures. Consumer prices rose unexpectedly higher, catching investors off guard. The report clearly shows that inflation has accelerated even more, surpassing the most pessimistic forecasts. The US Consumer Price Index in June jumped to 9.1%, notching the highest level in 41 years. Such a drastic spike was triggered by rising housing costs. Economists assume that inflation has finally peaked, so it's projected to slow down in the coming months as commodity prices are gradually normalizing as well. Higher than expected inflation is fueling speculation about more aggressive monetary tightening. The comments of some Fed officials made immediately after the release of the report also reinforced such expectations. Policymakers were almost unanimously in favor of raising the interest rate by 100 basis points, if new macro stats turned out to be higher as well. Christopher Waller believes that it's crucial to wait for the retail sales report before making a decision. If the reading is positive, it will be green light for further monetary policy tightening. Retail sales in June exceeded expectations, signaling stable demand. The probability that the Fed will raise the key rate by 100 basis points in July totaled 75%. Before the release of inflation data, it amounted to 7%. Last week, investors also took notice of a drop in long-term inflation expectations to a one-year low. It means that they factored in a less aggressive rate hike this month. According to the president of the Federal Reserve Bank of St. Louis, James Bullard, it probably doesn't make too much difference to do a 100 basis point rate increase or to do 75 basis points rate hike. Inflation could drop to 2% fairly quickly over the next 18 months if the Fed plays its card right. The current baseline outlook suggests a reasonable chance that a soft landing will be achieved, Bullard said. As the meeting will take place only next week, there could be new comments from Fed officials. At least investors are anticipating them. However, the Fed is unlikely to give new clues or signals, as only 1 week is left before the meeting. Following the release of inflation data, the stock market ended with the session with a modest decline, which was quite surprising. The Dow Jones sank by 0.67%, the S&P 500 slid by 0.45%, and the NASDAQ lost 0.15%. Friday's session was more buoyant. The Dow managed to gain 570. As for weekly results, the Dow showed a weak dynamic, trading at the opening levels of the week. Like two other major stock indices, it ended the week with a slight decrease, showing more distinct downward momentum. As for further dynamics, Wall Street is expected to be extremely volatile, at least until July 27. Therefore, traders should brace for sharp price fluctuations, as earnings reports will also impact market sentiment. For instance, speculators are now anticipating the quarterly reports of Netflix, DJIA, American Express, Bank of America, and Goldman Sachs. Market reaction is sure to be strong. Even more companies will soon deliver their reports, revealing to investors how quickly the economy is losing steam. Apart from that, the recession fears have not receded. They may also weigh on market sentiment this week. Although the economic calendar is empty, there will be some interesting reports. The housing market is cooling down. This week's data is likely to show signs of stabilization of sales. Traders are also waiting for the preliminary manufacturing PMI figures for July, which are dangerously close to the contraction level. As for S&P 500 index, it ended the week with a slight drop. The index recouped most its early losses on Friday. Its intraday gain was 1.6%. Despite some optimism, the main stock indices are still down. Bears are holding the upper hand. Thus, they remain near the support levels, separating a long-term bullish trend from a bearish one. Let's look at the trajectory of the S&P 500. It is aiming to reach 3,950, the high of the downward channel. The index could easily grow to this level, however it's unlikely to climb higher. After hitting this level, a drastic fall will certainly take place. It is expected to start within the next 2-3 weeks. The initial support level is located at the level of 3,860. A break below the support gap at 3,840 will weaken the uptrend. If the quotes drop below 3,740, the pair may test again the 3,637 level, a low of early 2022. Alternatively, the index still has the chance to climb above 3,950. In case of such scenario, short-term prospects will improve. The next resistance level will be located at 3,974, right before 4,017, a high of early June. If recession fears intensify once again, the index will lose the upward momentum immediately. Notably, a recession is expected to last until the beginning of 2023. Bank of America revised its year-end target for the S&P 500 index to 3,600, and 20% drop from its previous estimate of 4,500. The heavy tech NASDAQ 100 remained unchanged last week. It avoided losses thanks to Friday's upward rebound of 1.5%. Curiously enough, the stock indices fell a day earlier. The Nasdaq lost 1.7% on Thursday. A sharp decrease on Wall Street occurred after the publication of JP Morgan's earnings reports. Its revenue growth fell short of analyst expectations, fueling concerns about the economic downturn. JP Morgan's shares tumbled by 4.8%. Overall, the results of top US banks' quarterly reports were mixed last week. In addition, crucial macro stats eclipsed the release of their earnings reports. Citigroup's shares surged by 13% after the third largest US bank posted a smaller than expected drop in quarterly profit. Wells Fargo's stock climbed by 6% despite a 48% decrease in quarterly profit and the allocation of funds for bad loans. This week, investors are waiting the reports of other large companies like Tesla. The shares of the electric car maker have been showing unclear dynamics since May, fluctuating around $700. This consolidation may end in the coming days after Tesla publishes its second quarter earnings report. Earnings per share are expected to be almost half lower compared to the first quarter. However, the indicator is projected to rise by more than 28% in annual terms. Analysts believe that the revenue is likely to decline in quarterly terms, but show an increase in annual ones. Investors will closely monitor forecasts on Tesla deliveries. Earlier, Tesla announced that car deliveries fell for the first time in more than 2 years due to the closure of a factory in China and supply chain disruptions. In June, JP Morgan lowered its second quarter EPS estimate for Tesla shares, warning about the risk of high inflation, which could adversely affect the company's profit. That is all for now. Subscribe to our channel and have the most relevant market news at your fingertips. See you!